Hi, so in this video we are going to look into problem number 2. Problem number 2 appeared in the May 2019 exam for 10 marks. RM Steels Limited requires rupees 10 lakhs for construction of a new plant. It is considering three financial plans. The company may issue 1 lakh ordinary shares of rupees 10 per share. The company may issue 50,000 ordinary shares at rupees 10 per share and 5,000 debentures of rupees 100 denominations bearing a 8% coupon rate. 3. The company may issue 50,000 ordinary shares at rupees 10 per share and 5,000 preference shares at rupees 100 per share bearing an 8% coupon rate of dividend. If the company's earnings before interest and taxes are rupees 20,000, 40,000, 80,000, 1,20,000 and rupees 2 lakhs, you are required to compute the earnings per share under each of the three financial plans. Which alternative would you recommend? The tax rate is 50%. So in this question, we are required to make an investment of rupees 10 lakhs. For doing this investment, we have three choices in terms of raising finance. So let us take a quick look into what these three choices are, and they are basically asking us which choice should we pursue. Let's take a quick look into what these three choices are first of all. Choice 1 is an all equity choice. So it says 100,000 or 1 lakh ordinary shares of rupees 10 per share. So it is all equity. And if you look at choice 2, it is a mix of equity and debt. So they say 50,000 ordinary shares of rupees 10 per share and 5,000 debentures of rupees 100 denominations. So equity plus debt, 50% equity and 50% debt. So this is choice 2. This is yet another way of financing. And choice 3 is a mix of equity shares and preference shares. So let me call this as equity plus preference shares. Again 50-50 here as well. Equity and preference shares. Okay. Now, which choice should I go in for financing this 10 lakhs of investment? This is the question. And to do this, they want us to follow this method of EBIT to EPS analysis. So they want us to find out the impact on the EPS that every financing choice would have. But what's interesting to note is that they're not giving us one EBIT number and asking us to do this analysis. They want us to do this EBIT to EPS analysis in 5 different cases. For 5 different EBITs, what would be the impact on the EPS if choice 1 or choice 2 or choice 3 is considered? So different levels of EBIT is something that we need to be looking into. So if the project gave us 20,000 as the EBIT, then which choice is that we are going to be looking into? If the project gives us 40,000 of EBIT, which choice of financing will we look at? So on and so forth for 80,000, 1,20,000 and 2 lakhs respectively. So this is what we need to be addressing in this question. So let us do this by taking one level of EBIT at a time. So let us first look at 20,000 and let's go ahead with the calculation of EPS for the different plans. So I will call this as part 1, where I say that the EBIT will be 20,000. So whatever is the choice of financing, here EBIT is going to be 20,000. Now let us see what is going to be the impact on EPS with the different choices of financing particulars. Then let me have choice 1, choice 2 and choice 3. The starting point obviously is going to be EBIT, and for all the cases I'm going to write 20,000. Okay, now I'm going to be talking about subtracting interest. Here, there is not going to be any interest subtraction in the first choice or in the third choice because there is no debt. I'm going to have interest, which is coupon on debt, only in the second case, and that is going to be 5 lakhs into 8%, which is going to be 40,000. So out of the 10 lakhs of financing that I require, in choice 1, entire 10 lakhs comes in the form of equity shares. In choice 2, 5 lakhs is equity and 5 lakhs is debt. And in choice 3, 5 lakhs is equity and 5 lakhs in the form of preference shares. So on the 5 lakhs of debt in choice 2, I'm calculating interest. Interest is at 8%. If at all there is interest, it's at 8%. So I get EBT, which is earnings before tax. It's 20,000, and this is going to be negative 20,000. I have a loss here, and this is going to be 20,000 minus tax at 50%. So I can see that tax in the first case will be 10,000. In the second case, I'm not going to have any tax at all. There is going to be a loss here. So when there is a loss at the EBT level, there is no requirement to pay tax. In the third case, I again have tax of 50%, so it is 10,000. So I have EAT, earnings after tax. For the first choice, it is going to be 20,000. Second choice, negative 20,000. EBT is carried forward as EAT also. Just comes EAT, there is no tax. And then here again it is, I'm sorry, I made my bad here. It's not 20,000, it is 10,000. And here also 10,000. From this, I'm going to subtract preference dividend. Let me again abbreviate it as PD. I don't have preference dividend in choice 1 or in choice 2. I will have preference dividend only in choice 3, where I have preference shares. And here, when I'm talking about preference dividend, the preference dividend that I should pay is actually 40,000. Because in choice 3, the preference shares finance is 5 lakhs. The financing that comes from preference shares is 5 lakhs. And on that, if I apply 8%, that amount is going to be 40,000. But I don't have enough profits from which I will be able to pay my preference dividend. The EAT I have, the earnings after tax I have is only 10,000. Only from that I am going to be making preference dividend payment. So here I am going to make a payment only of 10,000. So I am going to make a payment only of 10,000. I am not going to make a payment of 40,000. So I will have PAES, profit available to equity shareholders. It is 10,000 here, and this is negative 20,000, and this is 0. Now, one question here, or one discussion that I'll make here around this preference dividend. Now, is this possible? In choice 3, when you actually have a preference dividend of 40,000, can you just pay 10,000 because you just have 10,000 at this level? Well, the assumption is that these preference shares that we talk about, these are cumulative preference shares, and what this means is now you pay preference dividend only to the extent of profits available, but probably next year you carry forward this arrears of 30,000, and then before paying any dividend to equity shareholders, this arrears is first settled off to the preference shareholders, and only then equity shareholders are looked at for dividend payments. So I am assuming here that these are cumulative preference shares, and this kind of treatment is possible, and that preference dividend is not a compulsory payment here. So depending on the profits available, I will make payment. So since I have 10,000, I will entirely pay out. I'll pay entire 10,000. I'll pay it off as preference dividend without having anything for the equity shareholders. But I am not going to say that there is going to be an expense of 40,000 here when the profit is only 10,000. So probably next year, which is not in the scope of our discussion now in this problem, that 30,000 would be paid. That's how I'm going to consider the preference dividend here. Now I will divide this by number of shares. So when I talk about number of shares, in the first case it is going to be 1 lakh. In the second case, it is only going to be 50,000 shares because I get balance financing in the form of debt, and then here also it's going to be only 50,000 shares. But when I calculate EPS, earnings per share, in the first case I get 0.1. In the second case I get 0.4, but this is negative. negative 40 paise, and here I get 0. So this is the EBIT to EPS analysis. Sorry. So I started from EBIT, again I came all the way up to EPS. So if I look at this analysis, it looks like at this moment equity is the choice one, is the best way to finance the investment because it has the highest EPS. Choice one has the highest EPS, and after choice one, the next that comes in the line is choice three, which gives me at least 0 of EPS. It does not give me a negative EPS, and then finally you have choice 2, which is actually a negative EPS. So basically it's like you're eroding shareholders wealth as compared to choice 3, which does nothing to shareholders wealth, and choice 1, which adds a little bit to shareholders wealth. So yeah, so looking at this EBIT to EPS analysis, and when the EBIT is 20,000, I would go in for choice 1. This is for the first level of EBIT. Let us go for the second level of EBIT and do these same calculations, similar calculation. Second level of EBIT is 40,000. So here again, I'm going to draw up income statements for all the three choices, starting with EBIT as the first number in the income statement. So all the cases, now my EBIT will be 40,000. And I am going to be subtracting interest. And again, I don't have any interest at 8%. I don't have any interest in the interest expense in the first choice or in the third choice. I have interest expense only in the second choice, and that will be 40,000. Now I have earnings before tax. For the first choice, it is going to be 40,000. Second choice, it is a 0. And third choice, it is 40,000. Let me subtract tax at 50%, and I'll have 20,000 as the tax here. This is 0 and this is 20,000. So when I have no earnings before tax, obviously there's no tax as well. So for the other two cases, I have 50% tax. Then earnings after tax, this is going to be 20,000 here, 0, and then 20,000. Now, minus preference dividend. I don't have any preference dividend payment to be done for choice 1 and choice 2. In choice 3, applying the same logic that we looked into in the previous EBIT, in the previous calculations, at the previous EBIT level, here the preference dividend I would say would be 20,000. You have 20,000 of profits, well, you pay 20,000 of preference dividend as well, and that is still in arrears, which probably in the next year we are going to be settling that before we look into dividend payments for equity shareholders. Sorry for the alignment. Okay. Yeah. Now I get PAES, which is profit available to equity shareholders. So this is 20,000 here, 0, and then this is 0. So now I have my number of shares by which I should divide. And in the first case, it's going to be 1 lakh shares. The second case, it's going to be 50,000 shares. And in the third case, it's going to be again 50,000 shares. And now I have earnings per share, EPS. And for the first case, it's going to be 0.2. And for this choice 2, it is going to be 0. And for choice 3 also, it is going to be 0. So from this, what we understand is from this EBIT to EPS analysis, again, it looks like choice 1 is what we are going to be pursuing if the EBIT level is 40,000. If the EBIT is 40,000, then choice 1, which is all equity financing, seems to be the best because that gives us the highest EPS. Now, for some reason, if you're not going in for choice 1, then if you look at choice 2 and choice 3, probably you would be indifferent between choice 2 and choice 3 because both choices give you the same EPS of 0. So in both cases, you get 0. So choice 1, but if not choice 1, anything choice 2 or choice 3 should be fine. This is your EBIT to EPS analysis when the EBIT level is 40,000. So we understand that when the EBIT levels change, our conclusions regarding the all choices also change. Our conclusions regarding the method in which financing has to be done, that is also impacted by the EBIT levels as such. Now here you should be very careful in learning that when I say EBIT levels, if there is a specific EBIT level for all the choices, it is the same. But that itself could be different. For example, in the previous case, if the investment gave me 20,000, then what is the EPS for all the cases? In the second case, if the investment gave me 40,000 of EBIT, what is the EPS? So within one EBIT level, for all choices, the number is the same. But that EBIT number itself, we are assuming that to be different because the project could be giving me a good operating return, could be giving me a relatively lesser operating return, or whatever it is. So that's what we're analyzing here. So we should be very careful in understanding. So it doesn't mean that with different sources of financing, EBIT is changing. The project itself is giving me different levels of operating profits. That's something to be carefully captured here. So with that, let's go to the third level of operating profits. Let's calculate EPS here, EBIT. Here the EBIT level is going to be 80,000. So again, similar calculations, particulars, choice 1, choice 2 and choice 3. Let me start with EBIT. That's going to be 80,000 for all the choices. Now, I'm going to subtract interest at 8%, coupon at 8%. Again, nothing for choice 1 and choice 3. For choice 2, I have 40,000. I subtract that. And I have earnings before tax. That is going to be 80,000 here, 40,000 here, and 80,000 here, from which I subtract tax at 50%. So this is 40,000 and this is 20,000, and here again it is 40,000. I get my earnings after tax 40,000, 20,000 and again 40,000. Now from this I'm going to be subtracting preference dividend, again only in choice 3, but now I'm going to subtract 40,000. Now I have profits to pay the entire dues that I have towards my preference shareholders. What I need to pay them is 40,000 and what I have available with me is also 40,000. So let me calculate my PAES, profit available to equity shareholders. That is 40,000 here and this is 20,000 here and this is 0. Now I need to divide this by number of shares. So in the first choice it's going to be 1 lakh shares. The second choice it's going to be 50,000 shares. And in the third choice it's going to be again 50,000 shares. If I look at EPS, in the first choice it's going to be 0.4. In the second choice it's again going to be 0.4. And in the third choice it's going to be 0. So if I look into this EBIT to EPS analysis, probably I conclude saying that you either go in for choice 1 or you go in for choice 2. You probably can be indifferent between choice 1 and choice 2 because you get the same EPS. So if the level of EBIT is 80,000, then either choice 1 or choice 2, anything is fine. You can be indifferent between the two choices because they give you the same EPS. But obviously choice 3 is inferior because it gives you a lesser EPS. In fact, it gives you 0 as the EPS. So here again, this is one more opportunity for us to understand that the level of EBIT also plays a role. Right? When the EBIT level was 20,000, among the three choices, choice 1 looked to be the best. When the EBIT level was 40,000, then among the three choices, let me go to the previous one. Among the three choices, we saw again choice 1 to be the best, and now when the EBIT level is 80,000, among the three choices, we see choice 1 or choice 2 to be the best. So we can be indifferent between choice 1 and choice 2. Now let's see what is in store for us if we go to the other levels of EBIT. We still have two more levels, 1,20,000 and 2 lakhs. This is the fourth one. So EBIT is rupees 1,20,000. Similar calculations, particulars, choice 1, choice 2 and choice 3. Starting point EBIT for all the cases 1,20,000, and I subtract interest at 8%, and that's going to be only in choice 2, and that is going to be 40,000. And now I have earnings before tax. In choice 1 and choice 3, it is going to be 1,20,000. And in choice 2, it is going to be 80,000, from which I subtract tax at the rate of 50%. Choice 1 and choice 2, it is going to be 60,000 of tax. And choice 2 is going to be 40,000. Now I have earnings after tax, and you can see that it's going to be 60,000 for choice 1 and for choice 3. And for choice 2, you can see the earnings after tax to be 40,000 minus preference dividend. Choice 1 and 2, nothing. Choice 3, 40,000. Now you have profit available to equity shareholders. We have 60,000. And then you have 40,000. And then you have 20,000. Now you divide this by number of shares. 1 lakh in the first choice. Then I have 50,000 in the second choice and 50,000 in the third choice, number of equity shares, which gives me EPS of 0.6 in the first choice, 0.8 in the second choice, and 0.4 in the third choice. So if I now look into this analysis, this EBIT to EPS analysis, from this what I understand is choice 2 seems to be the best. Choice 2 seems to be the best because it gives me the highest EPS of 0.8. For some reason, if that's not possible, then the next choice that I would look at is choice 1 and only then choice 3. But anyway, choice 2 is the best. So when the EBIT level is 1,20,000, I go in for choice 2. Let's go to the last one, which is fifth case where EBIT level is 2 lakhs. Now we'll draw up the income statements for this as well. But after this, we're going to put all things together and understand what's going on. That's going to be an interesting understanding where we'll see how different levels of EBIT are pointing fingers to different choices. So, well, let me first complete this now. Choice 1, 2 lakhs, all choices, same EBIT of 2 lakhs. From this, I subtract interest at 8%, and that's only going to be for the second choice, but that's going to remain at 40,000. That gives me earnings before tax. That is going to be 2 lakhs, and here it's going to be 1,60,000, and here it's going to be again 2 lakhs, from which let me subtract tax at 50%. So I have 1 lakh in choice 1, I have 80,000 in choice 2 as tax, and I again have 1,60,000 in choice 3. So now I have my earnings after tax, that's 1 lakh here, it is 80,000 in choice 2, and it is also, well, this is 1 lakh. So this is again 1 lakh here, minus preference dividend. That's only going to be in the third choice. That would be 40,000. I have my profit available to equity shareholders. This is going to be 1 lakh. This is going to be 80,000, and this is going to be 60,000. Let me divide this by number of shares. 1 lakh here, 50,000 here, and again 50,000 here. So if I calculate my EPS, for the first choice it's going to be 1 rupee, and for the second choice it's going to be 80,000 divided by 50,000, which is going to be 1.6 rupees, and in the third choice it is going to be 60,000 divided by 50,000, which is going to be 1.2 rupees. It's going to be 1.2. Now, if I look into this analysis, what I understand is again, choice 2 seems to be the best. So if the EBIT level is 2 lakhs, then choice 2 seems to be the best because it gives me the highest EPS of 1.6. For some reason, if choice 2 is not going to happen, then the next choice I would probably look at is choice 3, which gives me 1.2, and only then would I look at choice 1, which gives me a lesser EPS of rupee 1. Rupee 1. So, we've answered this question. For each of the 5 cases which have different levels of EBITs, we have said which choice seems to be better by doing an EBIT to EPS analysis. But what I am going to do now, now at this stage, the answer to this question is over. So if this question appears in the exam, here ends the answer. But I'm going to go a step forward and I'm going to analyze what has happened here. So let us have um, a small summary table. So EBIT, and then here I'm going to have EPS. We're going to have 3 choices. So for different levels of EBIT, let's put together all the calculations that we have done, and we'll try to see, sorry, it's choice 3. We'll try to see what's coming out if we can make some conclusions or some observations here. 20,000, 40,000, 80,000, then 1,20,000 and 2 lakhs. So let me also number them so that we know we are talking about 5 independent cases, 5 independent levels of EBIT. Let's go to the, let's do case by case. Let's go backwards. 1, 1.6 and 1.2. So 1, 1.6 and 1.2. So let's look at 1,20,000. It is 0.6, 0.8 and 0.4. 0.6, 0.8 and 0.4. At 80,000, it is 0.4, 0.4 and 0. 0.4, 0.4 and 0. And then at 40,000, it's 0.2, 0 and 0. 0.2, 0 and 0. And finally, the first level of 20,000, it's 0.1, negative 0.4 and 0. 0.2, sorry, I think it's 0.1. 0.1, negative 0.4 and then 0. Now, let us see what were the conclusions that we had. If it was choice 1, sorry, if it was 20,000 of EBIT, we went in for choice 1, which was all equity. If it is 40,000, we went in for again choice 1, which was all equity. If it was 80,000 as the EBIT, we were indifferent between choice 1 and choice 2. If it was 1,20,000, we said we'll go in for choice 2. And if it's going to be 2 lakhs, we'd go in for choice 2. So none of these levels we were going in for choice 3. So it was either equity or it was debt or it was an indifference between equity and debt. So this is the level. So I would call this as a level where you're indifferent between choice 1 and choice 2. So what we understand is for any level of EBIT, okay, for any level of EBIT, which is till 80,000, I'd call it like this. Till 80,000, if you see, in all these cases, you will have equity as to be the preferred choice. Till 80,000. At 80,000, I would say this as an indifference point, and after 80,000, debt seems to be a better source of finance. So this is what comes out in our analysis, right? So at 80,000, that's the indifference point. Anything is okay. Before 80, for every level of operating profit lesser than 80,000, equity is better, and for every level of operating profit higher than 80,000, debt seems to be better. So why does this happen? What's making this happen? What's the logic behind this? The logic is simple. Now I'll take you back to the discussion that we had in the topic called as leverages. If you've not watched the videos in this topic called leverages, I would suggest you do that. There are 5 videos that I've uploaded in this topic called leverages. Please take a quick look into that. If you recollect the discussion that we had in leverages, when a lot of good is happening, and you know that good is the only thing that's going to happen, debt is the best source of finance because debt makes good look even better. But when you're not really sure if good is going to happen, or if you're not reached a certain level of good, then debt is risky, equity would be a little better, right? Because equity is a source of finance which is probably variable, right? There is no question of any payments that you should make on equity when your business is not doing well. But when you talk about debt, it has a fixed payment. So up to 80,000, this is, I would call this as one level. Up to this, you can't really trust debt. It might pull you down. But after that, if you see, when you have really established the fact that your operating profits are really good, I would say these two situations, if you look into that, this is a case where you're actually doing very well. So if you deploy debt in your capital structure, you can do better, right? So debt will make good things look even better. That's why you can see that in 4th and the 5th cases, you will see debt scoring compared to equity. But in the first 2 cases, you will see equity scoring compared to debt. So the level at which you're operating, the level of operating profit at which you're operating, that definitely has something to do with the source of financing. Up to a certain level, going in for debt is not justified. After a certain level, you should go in for debt to take the advantage of leverage and have a higher EPS for shareholders. So this is an analysis. In one slide, you can see all that we have done, and we can see what's going on and what is the conclusion that we can draw. This was a nice little problem. In the next videos, we'll look at the other problems in this topic area.